What if the most significant threat to your 2026 capital expenditure plan isn't a shift in consumer demand or a competitor's breakthrough, but a fundamental collision between trade policy and monetary stability? Imagine a scenario where a universal 10% tariff is implemented overnight, immediately injecting a 1.3 to 1.7 percentage point spike into the inflation index. For manufacturing executives, this isn't just a political debate. It is a direct challenge to the Federal Reserve's dual mandate. As we look at the landscape for 2026, the prospect of aggressive trade protectionism is no longer a peripheral risk. It is the primary variable that could freeze the Federal Reserve's ability to cut interest rates, forcing your borrowing costs to remain elevated even as economic growth begins to cool. For industrial leaders, the next 18 months will be defined by how the Federal Reserve navigates the stagflationary trap. While many in the C-suite have been banking on a cycle of rate normalization to fuel expansion, the potential re-imposition of Trump-era tariffs creates a profound inflationary headwind. We are seeing a resurgence of trade protectionism, specifically the proposed 10% universal tariff and targeted 60% tariffs on Chinese imports. Current market data indicates that these are not merely taxes on foreigners, but significant consumption taxes that act as an immediate inflationary pressure point. When the cost of every imported component and raw material rises, the Federal Reserve faces a brutal dilemma. Do they cut rates to stimulate a domestic economy slowed by trade friction, or do they keep rates high to combat the very inflation those trade frictions created? For the manufacturing sector, this means the relief you expected in 2026 is increasingly at risk of being postponed indefinitely. Recent industry research highlights the scale of this disruption. Analysis from Oxford Economics suggests that the combined impact of broad-based tariffs could drive U.S. inflation up by as much as 1.7 percentage points. This is a staggering number for a Federal Reserve that has fought tooth and nail to return to a 2% target. Leading analysts from firms like Goldman Sachs and Morgan Stanley are already projecting that these pressures will compel the Fed to maintain a hawkish stance much longer than the market currently anticipates. We are looking at a potential reduction in U.S. real GDP by 0.7 percentage points, alongside the potential elimination of 800,000 jobs. This creates a stagflationary environment, high inflation coupled with stagnant growth, the exact scenario that makes central bank policy unpredictable. When the Fed loses its clear path to rate cuts, your cost of capital remains high, even as your input costs for steel, aluminum, and electronics begin to climb. This shift is already driving a fundamental restructuring of industrial strategy. Over 60% of manufacturing executives surveyed by the National Association of Manufacturers report that they are already anticipating increased input costs due to potential tariff actions. This has triggered an acceleration in friendshoring and reshoring initiatives. The goal for these leaders is no longer just lowest unit cost, but maximum supply chain resilience. By moving production closer to home or into politically aligned nations, companies are attempting to bypass the volatility of a trade war-driven economy. However, this transition is expensive and capital-intensive. If the Federal Reserve is forced to hold rates at restrictive levels to counteract tariff-induced inflation, the very companies trying to reshore their operations will find the financing for those new domestic plants to be prohibitively expensive. It is a paradox. The policy intended to bring manufacturing back to the U.S. could create the high interest rate environment that makes the necessary domestic investment difficult to sustain. The risk of global reciprocity cannot be ignored by anyone managing a multinational footprint. Leading analysts point to a high probability of retaliatory tariffs from the European Union and China, which would further dampen global economic growth and depress demand for U.S. exports. This global trade imbalance is often accompanied by an appreciation of the U.S. dollar, as capital flows toward perceived stability. While a strong dollar might seem like a benefit for importers, it makes U.S.-made exports significantly more expensive on the global stage, further eroding the profitability of domestic manufacturers. The Fed is then forced to weigh these complex feedback loops. If the dollar is too strong and trade volumes are plummeting, the central bank might want to lean dovish, but they are effectively handcuffed by the persistent inflation sparked by the initial tariffs. This creates a level of monetary policy divergence and uncertainty that we haven't seen in decades, making any fixed-rate long-term planning for 2026 a high-stakes gamble. My challenge to you this week is to move beyond the high-level headlines and get granular with your finance and operations teams. Sit down with your CFO and your head of supply chain to run a 10-60 stress test. What happens to your margins if a 10% universal tariff and a 60% Chinese tariff are implemented alongside a Federal Reserve that refuses to cut rates through the end of 2026? You need to identify precisely which components in your bill of materials are most vulnerable to these protectionist shifts and determine if your reshoring plans are financially viable in a sustained high-interest rate environment. Strategic resilience isn't just about moving factories, it's about ensuring your balance sheet can survive the friction between fiscal trade policy and monetary reality. If you found this analysis valuable, ensure you are subscribed for our upcoming deep dives into industrial policy and economic strategy. The landscape for 2026 is shifting rapidly, and we will continue to provide the data-driven insights you need to lead with confidence. Please like this video and share your thoughts in the comments. How is your organization hedging against the possibility of a higher-for-longer rate environment driven by trade policy? I look forward to continuing this conversation. In our next session, we will examine the specific